Thank you for joining me. I'm Alex, and I want to talk about credit today. So, what is credit? Basically, and originally, credit is basically the risk you pose to a lender that wants to give you money and needs to know how likely you are to pay it back. And a credit score is basically an approximation of all the factors and weightings to kind of put that in a simple number. It's not that simple, and it depends on kind of where you want to get credit and what for. So the criteria are payment history, credit utilization, types of credit used, age of accounts, total debt, public records, and number and age of accounts. So basically, how often you pay your bills, or rather, how often you pay your bills in full on time. Utilization, which means how much of your credit limit you use every month or whenever, really. Types of credit, so mortgage, for example, car loan, just student loan, credit cards, other consumer credit, unsecured loans. So there's a few different types of credit. The more you have, the better your credit score will be. Age of accounts obviously means the longer you've had credit, the better your score is going to be, because the all the other factors basically are more reliable. Then obviously total debt, pretty self-explanatory. Public records, which means bankruptcies and judgments and all that. And recent accounts. So if you recently opened a couple credit cards, you're unlikely or unlikelier to get a new one, or to get a different loan, because obviously you're kind of shopping around to get more and more credit lines. So that's obviously kind of a risk factor there. Now, most of these can be ignored. Credit utilization does not matter unless you need credit right now. Types of credit used, you can't really do much about that. Age of accounts, unless you have a time machine, there's not much you can do. And total debt, again, if you're paying as much as you can on your debt, there's not much else you can do there either. Things you need to actually do: obviously pay your bills, preferably on time and in full. Anytime you don't pay a bill within 30 days of its due date, you basically lose some credit for a worse credit history. So basically, the 30 days that you would be late on your bill still counts against you in terms of fees for late payment and things like that, but it doesn't really matter for the credit itself. Obviously, you'll save much money if you pay it on time, so definitely do that anyway, but there's a bit of a grace period. Public records, obviously, you should avoid bankruptcies and things like that. Not much else to say here. Number and age of accounts, you can obviously keep increasing the open accounts that you have, and if you want really good credit, you should probably do that, but you should not really pay for that. So anytime you open a credit card, you should make sure that it has no annual fee, and if it does have an annual fee, closing that account will impact your credit score in a negative way. So make sure you actually want to keep that open. Obviously, no one can predict the future, so it doesn't really matter that much, but I would prefer to just open credit cards and other lines of credit if there's no annual fee that I have to pay on top of all the other payments that I make. Credit utilization, kind of a double entry here. You can't really do much, but you should obviously try to get it as low as possible when you actually need credit, which means the credit report only saves a snapshot, and that is my credit cards all report on the date that the bill comes out. So they report when the bill is due and how much I owe. And so if I make a payment before that date, it will get reported as lower. So you can mess with your credit a whole lot by just paying things sooner. And if you need credit right now, you should pay off as much of your credit card debt as you can, and that will lower your utilization. And then you will they will report a lower balance, which improves the credit score significantly. Now, the credit score is kind of just an approximation and kind of just tries to fit things neatly into a single number. But different lenders look at different things, and you can have a nice 750 credit score and they still won't give you money because other factors like just having one credit card open and you're trying to get a mortgage. They probably want more than that, and they probably want more of a history. So obviously talk to whoever you're trying to get money from and what exactly they're looking for, but overall pretty much everything has an impact in a different way. If you're looking for more credit cards, they obviously mainly look at the open credit cards, what the balances are, what the payment history is, and how long they've been open. But for a mortgage, that might not be enough. So in many ways, things just aren't as simple as they seem, and so there's many things you can do and many things you just need to wait for, obviously. But that should give you a quick introduction on how to build credit and what you need to do right now. And basically, if you don't need credit right now, and if you don't need credit within the next half year or year or so, opening a credit card will probably help you in about a year. And that kind of always holds true. So unless you have a spending problem, but that's a whole different issue. But more lines of credit will help you. Older accounts will help you, and keeping the utilization down kind of doesn't matter unless you need credit right now. Unless, you're worried about paying interest, which I definitely don't recommend. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.